This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asia to open off a fresh record high on Wall Street. The ceasefire between Israel and Hezbollah helping calm some of the broader geopolitical concerns stirred by Donald Trump's latest tariffs over. Bloomberg learns the president-elect wants Kevin Hassett to lead the National Economic Council, spearheading his tax, trade and spending agenda. And New Zealand's Reserve Bank expected to deliver a second straight jumbo rate cut today, along with fresh forecasts on a slowing economy.
Take a look at how U.S. futures are coming online after stocks touched an all-time high again, the 52nd this year for the S&P 500 already. We're talking about more geopolitical risks being priced in, easing Israel and Hezbollah reaching that ceasefire. And this even leading to gains despite the fact that we saw Fed officials indicating a more careful approach to rate cuts according to the Fed minutes. You have U.S. futures not doing much at the moment, but we continue to watch crude prices. A little bit of a rebound after they dropped in the regular session. Of course, we had it settled beneath $69 a barrel, as you can see right there, but that was before the news of this ceasefire. We are also factoring in lots of other news. A risk-off mood from tariff threats. Of course, we know that those tariffs on energy products could hit the markets again if they're realized by the Trump presidency. We also have some light pre-holiday trading, not to mention, Haidi, that OPEC Plus nations are discussing delaying planned production increases as well.
Well, as you said, Shery, at a time where there's so many different types of geopolitical tensions affecting these markets, this is a major one to calm some of those nerves. President Biden says that the ceasefire deal is a major step towards ending the conflict in the Middle East.
Under the deal reached today, effective at 4 a.m. tomorrow local time, the fighting across the Lebanese-Israeli border will end. This is designed to be a permanent cessation of hostilities. What is left of Hezbollah and other terrorist organizations will not be allowed.
For more, Bloomberg's Michael Heath joins us now. So what do we know about the contours of this agreement and I suppose whether it could lead to further such truces elsewhere?
Yeah, it's a key question, Heidi. I mean, so the truce is supposed to come into effect, as President Biden said there, in about just under 3 hours' time from now. So it's based on 1701, the UN resolution from 2006, which stopped the last war. And part of the reason for that is that because of the turmoil in Lebanon, it means it doesn't have to go through any legislative processes or anything like that. The point is to try to get this actually enforced, which it wasn't last time. So the idea is that the US has got to be fairly heavily engaged in monitoring that Hezbollah sticks by its side of things. And Israel obviously needs to withdraw from Lebanon. It's interesting, though. I mean, in a sense, the reason that Israel's opted for this is, number one, that they wanted to give something to Trump, the incoming Trump administration, I think. But also, this is ground operations in Lebanon historically have, they end up costing a lot of lives for Israeli forces in the end. So there's only so long you want to go in before you get out and, before you lose too many soldiers. But it's a 60-day truce. And the key question really is Israel wants the right to be able to strike at Hezbollah if it sees any signs that it's returning to those areas that are supposed to be evacuated. It's supposed to go about 30 kilometres away from Israel's border. And also that they want to stop any of the supplies coming through Syria to Lebanon as well. So they're sort of going to be the pressure points, whether Hezbollah is, sticks to the letter of the law or whether, as in 2006, all this is said and done, and then as time goes by, it starts to creep back to where it was, which is more than likely to happen because as time goes by, the ability of Israel to restart a war becomes much more difficult.
Yeah, so what needs to happen within those 60 days in order for us to get to a longer-term ceasefire?
Well, Shery, I think everyone's pretty confident that is going to happen. But a key point is this policing of the area. I mean, you have UN forces there, but they've been able to do very, very little in terms of restraining Hezbollah or maintaining security in the area, basically to Israel's satisfaction, and to allow Israel to have its communities in the north there live safely. So really, it's whether the UN can step up there, and also whether the Lebanese army, which is supposed to be an adjunct there and help maintain security, whether they're able to achieve that. Now, the US has said that it's going to help them there, and it's going to try and help economically with Lebanon. It's in a really parlous state, its economy, its governance system, everything. So that's going to take some resources, and we just have to wait and see how that unfolds. But all the words are right, but they were right 18 years ago as well. We just have to see what happens on the ground. But given we've got this 60-day period and we've had so much conflict and there's such a desire for peace, I think, and for the Biden administration to at least get one front solved here, I suspect that we're probably going to get through it.
All right, Bloomberg's Michael Heath there with the latest on geopolitical tensions in the Middle East. As we get breaking news as well, we're continuing to see the outlines of the Trump administration. Now, President-elect Trump's transition team is readying an announcement of Jamieson Greer as U.S. Trade Representative, and we've now got the news that they're actually preparing to announce him as Trade Representative. Now, Jamieson Greer's selection really highlighting the central role that tariffs will play in the economic agenda of the incoming president. He was a longtime protege of Robert Lighthizer, who served 4 years as Trump's first U.S. trade representative and, of course, oversaw those billions of dollars in tariffs on both allies and adversaries as well. So we are now seeing that President-elect Trump is preparing to announce Greer as U.S. trade representative, according to people speaking to Bloomberg. We had already seen a big market reaction from the tariff threats coming from the president-elect. Take a look right now at how currencies are trading at the moment, because we had even seen a safe haven reaction on the Japanese yen that usually has continued to weaken despite rising risks. Right now, we're seeing it at that 153 level against the U.S. dollar. We had already also heard comments from Prime Minister Ishiba as well, talking about continuing with pay hikes. So there might be a little bit of a calculation of BOJ rate hikes to come. The Aussie dollar had already been pressured as well on the tariff news. We are getting CPI numbers out of Australia today. Offshore yuan was at a 4-month low against the U.S. dollar after the tariff news. Additional 10% tariffs on China, and the Mexican peso also trading around that 2-year low against the dollar. Bloomberg Economics sees Trump's latest tariff threat slashing U.S. imports and rerouting a huge volume of global trade. Global economics correspondent Anna Curran is here with us. And of course, it depends whether or not these tariffs actually materialize. But what are the calculations and estimates right now?
Yeah, look, on face value, it's a potential big trade shock. Of course, the sectors most exposed would be autos, for example. The US and Canadian car industry are very much interwoven in terms of components and parts and assembly. So you would see a big hit to Canadian exports into the US. Likewise, on the Mexico side, Mexico has become in recent years much more of a hub for manufacturing, for the offshoring story, to get closer to the US market. So again, you would see an impact there, not just, by the way, on components and cars, but also on foodstuffs as well. So I think for both Mexico and Canada, this warning would certainly, if it was to be enacted, would hammer both countries' exports. We've seen that reaction in their currencies this morning as well. The big question becomes whether this will be the final outcome or whether or not it's a starting point for negotiations between the US and its two neighbours.
And we have just heard the announcement when it comes to more of the outlines when it comes to the people that will be kind of shaping trade policy, right? They're preparing to announce Jamieson Greer as a trade representative, as a US trade representative. And, this is a person who, even back at the start of the year, had said that if successful, President-elect Trump would be announcing trade tariffs immediately as soon as he starts his second stint in the White House. So does this give us just a clear indication of the direction and the seriousness with which, at least on this policy, they're wanting to translate campaign rhetoric into actual policy?
I think it does, Heidi. Like you say, there's been a consistency when it comes to trade and tariffs from the Trump administration. This is one policy tool that they're deadly serious on. Greer is well known and established in the trade community, and his appointment would kind of bring the economic team together now with the Treasury and with the National Economic Chair and with the Commerce Secretary all being appointed, and all of whom are very much on board for President-elect Trump's campaign on tariffs. As we say, going forward, the details need to become clear, though. There's still a view out there that incoming President Trump will threaten very high tariffs on key trading partners, but ultimately use those as leverage and kind of meet them halfway through the middle. That, of course, is the key unknown. And equally, on the other side, let's not forget the threat of retaliation. Mexico's president today, Claudia Sheinbaum, using her press conference to make the point that they can also respond with tariffs. She highlighted U.S. automakers by name who operate in Mexico and made the point that they can hurt U.S. business too. So, yes, the threat of tariffs is real, but it's going to take a while to nut out just exactly how they will be enforced, what level they will be enforced by. We'll have to wait and see what the new administration does when they get up and running.
Yeah, the issue of retaliation, but also domestically how these countries respond will be interesting, right? We know there are some options that are perhaps, more dramatic and less palatable for Beijing when it comes to their holdings of US Treasuries, for example. But I'm also curious, do you think this kind of means that we're going to see more earlier or potentially more sort of spread out stimulus measures from Beijing in response?
Well, I guess there is a view that China's policymakers have been kind of holding fire, so to speak, Heidi, when it comes to how much money they would put into the economy, because they knew, of course, there was a chance of a Trump administration. Now we've had the election, President Trump is on the way, and they know, of course, already they've had a warning, a shot across the bow of a potential 10% tariff on Chinese exports. So they know full well they're going to be heading into very protracted negotiations with President Trump, and that by extension will surely have to inform their own thinking when they have the Works Conference in December, heading into the NPC next year, in terms of how much support the economy will need. And a lot of economists say that more fiscal spending will be coming from the Chinese authorities. They're just trying to gauge and game out the extent of the hit they're going to be taking from the Trump administration, because, again, when it comes to the trade story, China has options to respond and retaliate, but it is also vulnerable to hefty exports from the US, and, of course, tariffs on trading partners where Chinese companies have relocated production to as well. So they are vulnerable on several fronts to potential trade war with the new administration.
Our global economics correspondent Andy Curran there in DC. And of course, one of the economies we're watching very closely are here in Australia and New Zealand, just a couple of the markets that will get that sort of proxy impact of what happens in terms of the Chinese economy and some of those global trade flows. We are seeing for the minute, though, a pretty broad upside when it comes to trading here in Sydney. We're just about 12 minutes into the start of the session, but at the moment, broadly, we're seeing just about every single sector in the red, and in fact, some of the leadership coming through from consumer discretionary, financials rebounding from yesterday's laggards in the banks, and real estate as well. We're seeing a little bit less enthusiasm when it comes to energy as well as materials as we continue to process the ceasefire news between Hezbollah and Israel. Watching Kiwi assets today, of course, it is the Reserve Bank of New Zealand's decision day, and they are expected to cut the official cash rate by 50 basis points, an effort to jumpstart growth, turn around weak consumer demand. Paul Allen joins us now, and of course this broader backdrop of how tricky the next 4 years could be from a trade point of view, from a global trade point of view, is very much something that no doubt Governor Orr and all these other central bankers will be thinking about at the moment too.
Definitely. And for New Zealand, such a small and very trade-exposed country. But today's decision, at least the RBNZ's got one thing under control, and that is inflation. It's back down to 2.2%. That's below or getting very close to the midpoint. There's some expectation that inflation may even undershoot the midpoint. So it's back inside the target range for the first time in 3 years. Wage inflation's also eased as well. But the flip side of that is growth has absolutely hit the wall. New Zealand's having its second recession in 2 years. GDP seems shrinking again in the third quarter. We'll get those numbers in about 3 weeks' time. Consumer spending was down last quarter. Unemployment's up. It's at a 4-year high. So plenty of reasons for the RBA to move and move aggressively today. 50 basis points seen as a certainty. We've got one economist surveyed saying 75 basis points may even be on the table.
Yeah, some people thinking it could be a big 75 basis point move because the next meeting is really far off from now, right? So what can we expect in terms of rate decisions in 2025?
Yeah, that's right. It's that time of year, really, where Australia and New Zealand collectively head to the beach and take the phone off the hook, and nobody does much until they come back in the new year. So no meeting from the RBNZ until I think it's February the 19th, so a long, long way off. So there is some expectation that, look, they might go large to get ahead of the curve here. That said, economists do see the RBNZ maybe taking a less aggressive path for 2025. There's a forecast that the cash rate's going to be at 3.5% in the middle of next year, and that's seen as the neutral rate. But as Heidi mentioned, there are really a lot of variables here. One of them is the dairy price. That's been recovering. Milk powder, very important to the New Zealand economy. But of course, China, so important to the New Zealand economy. And as Ander was explaining, a really uncertain 2025 in store in terms of US-China relations and what it means for China's smaller trading partners.
Hold on in there in Sydney. We have more ahead on the Asia trade. This is Bloomberg.
I am determined to do whatever it takes to prevent Iran from obtaining nuclear weapons. I have said many times that a good agreement is an agreement that is enforced, and we will enforce it.
Israeli Prime Minister Benjamin Netanyahu there, and let's get some views now when it comes to the landscape for geopolitical risk. Nick Schoenmaker, who's a client portfolio manager at Drummond Capital, is with us. And Nick, really great to have you with us. Obviously encouraging for a number of reasons to see this ceasefire.
Yeah.
There's still a quite significant risk that, do you think markets are sort of underappreciating that this could just be a 60-day situation? In the past, we've seen things kind of start to dredge up again.
Yeah, it's good. I don't think any of the underlying issues have really been solved yet in terms of whether we can get anywhere near a two-state solution or not. I think moving Hezbollah back past the Litani River, which is that kind of UN buffer zone, I guess will allow some of the residents to move back to the north of Israel. But, I mean, it could really flare up again really quickly. I think what's probably expedited this process is just that Lebanon is basically a failed state. You know, we've talked about it before. The banking system's collapsed. I think it was only back in 2019. $1 was 1,500 lira. It's about 160,000 now. There's no president. There's no reforms needed to get an IMF bailout. So the country's already been decimated. So to have this conflict, a ceasefire from a humanitarian perspective is certainly needed. But we've got Trump coming in, and I think he's going to have a very much a maximalist policy against Iran. We know back in 2015 we had the nuclear deal with Obama and Iran that he reversed. And I think there's been, you know, he's been talking about that there was an assassination attempt against him. So I think we're a very long way from being out of the woods, but it's great from a shorter term perspective. We did see the energy price soften a little bit off the back of that news.
Markets more broadly have been incredibly good at being sanguine about geopolitical risks, right?
Totally,
even as security, humanitarian repercussions continue to play out. Do you expect that to still be the same going into the next Trump presidency?
Yeah, I think so. So there's been times, you know, earlier this year where we did see the energy price and gold kind of quite well bid at the same time, and I think that was reflective of geopolitical risk. There has been a little bit of a war premium from time to time in the energy price, but it's been very intermittent. So it's at the moment, I think, look, it's probably safe to say gold gets a bit of an ongoing bid. You've got the central banks and the middle-income economies, the global south buying gold, I guess, to de-dollarise and move away after Russia was sanctioned. But it's hard to see what happens with the energy price when you've got cross-currents of, you know, China slowing down, notwithstanding the stimulus that we're seeing, which is probably going to increase after any tariffs are rolled out to China. But there's a lot of cross-currents affecting the energy price at the moment. So I think political risk, deficits in the G7 will see ongoing bid for safe havens outside of Treasury. And that geopolitical risk related to it probably means things like gold will be interesting from time to time.
And yet we're seeing U.S. stocks also continuing to rally. We're talking about headed towards a second year of 20-plus returns on the S&P 500. Could we see more gains from here in 2025? I mean, it's interesting that in your notes you say that we could be moving away from the Fed put to the Trump put.
Yeah.
Explain that to us.
Yes. I think just to answer the question, in the shorter term, I think, look, for the next 6 months, it does feel like there's probably going to be more buyers than sellers for US equities. I think US exceptionalism will carry on in the short term anyway. I think, because since the GFC we've moved away from the debt problems being in the private sector and the households to really moving to the public sector and governments, you can expect that we're going to get a lot more volatile waves of inflation. So that does make the Fed put a little bit more complicated. We know that Trump, one of his main measures of success, his ratings in the S&P 500 is right up there in the top of his scorecard. So I think one of the things we could see that would temper some of his policies that could be inflationary, whether it's tariffs, tax cuts, could be just if we get really strong long-end weakness in the yield curve, that could see some of his new, more Wall Street-friendly advisors like Bessent in the Treasury kind of tempering some of that just to make sure that it doesn't have too much of a detrimental impact on the S&P 500 essentially.
And yet you're moving to diversifying towards global small caps as well, real estate and other alternative assets. Why?
Yeah, so we still do have quite, I guess, long US exceptionalism. We are starting to see over the last few months some earnings broadening out to the 493 stocks in the S&P 500. We have been just granularly adding some more kind of, sector exposure outside of the NASDAQ. So we did add global small caps back in April on the expectation that if you do get somewhat of an easing cycle, all that's probably tempered now. You've got valuations that were very attractive. You're still at valuations that are below COVID levels versus large caps that are very expensive. And just a lot of the pro-growth business policies, reindustrialising the US economy could see some good opportunities selectively. You've got to be strong on the bottom up, but in global small caps. And just given that weakness that we've seen in Treasury since basically the Fed cut by 50 basis points, you've seen a big sell-off in infrastructure stocks, property stocks. So there just seems to be a little bit of value there and some diversification benefits. So we funded some of that out of some of our hedge fund book. We basically closed our hedge fund book, some of our diversifiers, and added to some of those sectors as well.
Nick, always great to have you with us. Nick Schoenmaker is a client portfolio manager at Drummond Capital. More ahead on the Asia trade. This is Bloomberg.
Take a look at some of the stocks that are moving in the after-hour session. We are now seeing Dell and HP's quarterly results missing analyst estimates, sending the stock lower. Dell more than 10% at this point, really showing how we're seeing that disappointment in that long-awaited recovery of the PC market. Dell's revenue declined 1%, HP's rose 2%, but both missing expectations. CrowdStrike shares also falling after reporting a weaker than expected fourth quarter earnings forecast that, of course, disappointed investors who have been watching for signs that the company has recovered from a massive outage back in July. We have more ahead on the Asia trade. This is Bloomberg.
We absolutely have a population that is far more sensitive to inflation than it's been in decades. And therefore, I think tariff policies this time is very different than tariff policies back in 2018, 2019.
President Trump's also using this tariff threat to tell the new government in Mexico City, let's get serious about the migrant flows across Mexico's border and get back to our Remain in Mexico policy.
We think that the big loser here is Europe. I mean, I think that if you look globally, That's the big loser.
We are an importing nation, so leaving the tariffs aside, that actually serves to potentially worsen the trade deficit.
I don't think they'll be effective on day one, even if he announces them on day one. There'll be a court challenge immediately, and a federal judge may issue an injunction effectively delaying the tariffs.
Some of our guests discussing Donald Trump's latest tariff threats against top U.S. trading partners. For more analysis, let's bring in Marc Busch. He's a Carl F. Landiger Professor of International Business Diplomacy at Georgetown University. Marc, great to have you with us. What do you make of these threats? Because we have seen him link them to illegal immigration and drugs, not necessarily to economic fundamentals. So is this just a negotiating tactic? What can we tell about what his goal might be?
It seems that he wants to negotiate on day one, and that's what this is. It was really quite politically deft to decide to frame these as being about illegal immigration and about fentanyl. He has IEPA, the International Emergency Economic Powers Act, to use in this regard. So to deliver on some very politically salient campaign promises, this was a very interesting and very provocative stroke of genius. And look what it's done. It has rattled America's three closest trade partners in less than 12 hours.
And the fact that he named these countries, does that give you an indication of what he will prioritize in his first year in office? Because we do have the USMCA also review coming up in 2026. He did not mention Europe, though.
The European Union will come next. He was very adamant about going after Europe almost as much as he was eager to target China in his first term. This is about USMCA. This is about setting a marker for the renewal, which in his mind is actually a renegotiation. And he's gotten the Canadians to play right into his hand. It seems that Canadian politicians are more than willing to throw Mexico under the bus, as it were, and to move on to what we had in 1989, which was the U.S.-Canada bilat. So in all intents and purposes, this is going to go pretty harsh for both Mexico and Canada, but it is entirely about USMCA.
Where is the leverage at the moment, particularly when you take a look at the relationship between Washington and Beijing, right? China's domestic economic challenges are well documented. Does that give the incoming Trump administration and President-elect Trump himself a little more kind of leeway to be able to go even tougher than anticipated?
This won't be the last move against China, and I don't think he's making a lot of calculations right now about anything in terms of domestic Chinese economic prowess or what their prospects might be for policy reform and putting more of a burden on consumers in that country. This is political theater, and this is making a dramatic hit in the media cycle, and you're going to see a lot more of it in the coming weeks and months ahead. So grab a seat, because the show has just started. And to hit Mexico and Canada, China, not that surprising, but Mexico and Canada that quickly, he isn't even in office yet, and he has certainly more than got their attention.
What would be, do you think, the side effects that we see from this, right? Because on the other hand, we have seen previously President Trump really prioritising these bilateral trade accords. He's obviously not a big fan of multilateral agreements, but do you see that side being perhaps a little bit more strengthened in this second term?
The bilats exhausted him in his first term. After we got past U.S.-China Phase 1, there was no Phase 2. After he dealt with Japan, after he did side deals on the steel and aluminum tariffs with Mexico and Canada leading up to USMCA, he more or less chose to focus on different things. He quickly lost interest in being able to exert a lot of influence in bilateral deals. Interestingly, he didn't entirely give up on multilateralism. He did file WTO cases, for that matter, in his first term, whereas President Biden hasn't filed a single case at the WTO. I would also expect that he, on the offense, because bargaining means that you're going to have to ask for something, will use some of the coalitions that the U.S. has built at the WTO, in particular against the European Union, on a lot of farming issues, for example, to try and get some bang for the buck on that front. This isn't going to be a complete withdrawal from the global economy, but clearly he likes tariffs. He's made no qualms about that, and this is a big first opening salvo in the tariff game part 2. However, he will have a lot of domestic U.S. challenges to doing this. He is already going to find that this isn't as easy as he has been led to believe IEEPA is to enact. And the court challenges, as well as the political lobbying, as well as congressional questions about whether they are going to be able to reclaim tariff authority going forward, all of this is going to present a big headache within a short period. But on day one, you bet, this is where he's going to make his mark.
And Marc, we're now hearing from sources that Trump's transition team is readying the announcement of Jamieson Greer as USTR. And of course, he served under Robert Lighthizer, who was Trump's first USTR during his first term. What can we learn from Trump 1.0 that could be sustained into Trump 2.0? And are there some lessons, not to mention some challenges that he needs to overcome from that period? And I ask this because I understand that you have had a recent opinion piece talking about finishing what he started, especially when he comes to digital trade.
Yeah, so we all get to talk about the tariffs on the defense, and my point has been that I would expect Trump to play a little bit of offense, and that would be refreshing after 4 years, during which time the United States hasn't done anything on the offense except retreat. So when you take a look at things like digital trade, and the Biden administration pulled the plug on U.S. efforts in that sphere at the WTO, I would expect that Trump will take a more optimistic view as to what can be accomplished on the offense. This isn't unlike what he did in his first term, but there is some unfinished business, and the biggest bit of unfinished business is digital trade. The U.S. pulls out, and the remaining members of the Joint Statement Initiative on e-commerce gutted key provisions that have been long-standing U.S. policy preferences with respect to e-commerce. That has to be corrected for the sake of the United States, which, as you know, is a major digital trade exporter and has very few defensive liabilities to hold it back. That said, I would expect that there are going to be a lot of offensive interests, and I would expect that you're going to see a lot of those offensive interests targeting Europe, which has become a little bit of a unilateral entity unto itself, including with respect to the European Union deforestation regulation and other initiatives which are also taken independent of the input of other countries and are going to cause a lot of trouble at the WTO. The choice for USTR is an interesting one, not unexpected, and it suggests a bit of continuity with the Lighthizer regime. But I'm also expecting that, given that Greer is a well-experienced trade lawyer and has certainly done things that look offensive at times, that you're going to see a bit more than you saw under Biden with respect to the U.S., not just demanding that countries respect the tariffs coming into this country, but that they open up their own markets to get the tariffs to go away in their country.
Marc, really great to have you with us. Marc Busch is a Cal F. Landiger Professor of International Business Diplomacy at Georgetown University. Well, Trump's latest tariff threats have dulled some of the market optimism over the president-elect's Treasury pick, Scott Bessent. The former New York Fed president and Bloomberg opinion columnist Bill Dudley has a simple message for Bessent: good luck. He spoke to us about the main challenges that Bessent will face if confirmed.
I think he can explain very clearly the consequences of not having a good set of policies in terms of what that means for the budget deficit path, the consequences for interest rates, and if interest rates go up, the consequences of interest rates for broader markets, including the stock market. So I think he can, essentially be the voice of reason to make sure that the policy mix is actually intelligent and that the fiscal path the U.S. has put on a more sustainable one. Mm-hmm. Right now, we have budget deficits 6% of GDP or more as far as the eye can see. And President-elect Trump has said that he wants to cut taxes. He wants to extend the 2017 taxes cuts and cut corporate taxes even more. And, how are we going to pay for that? So I think there needs to be someone in Treasury who's viewed as credible, but not just credible with markets, but also credible with President-elect Trump.
I am curious. I mean, two components of the job of Treasury Secretary. On one hand, they do effectively act as an advisor to the president, but they're also basically a salesman to a certain extent. They have to go out to the public, to investors, and sort of convince them that these policies coming out of the White House are productive and, more importantly, going to benefit them. Do you think, what you know about Scott Bessent, do you think that salesman aspect of it, that he has the chops for it?
Well, we'll see. I think what he does have is credibility with market participants. And you saw it over the last 24 hours. The market reaction to his being named has been very favorable. Stock prices up, bond yields down. So people are happy that they have someone at the U.S. Treasury that's knowledgeable about financial markets. Now he's just got to take that knowledge of financial markets and make sure it actually affects policy, and that we have prudent policies in terms of tax policy and prudent policies on where the deficit's going over the longer term.
So that's where I want to go, because you say the markets were cheered by the nomination of Scott Bessent. But what exactly about Bessent has the bond market so relieved? When the reporting shows that commitment to tariffs, which we know are, or which we believe will be inflationary, was a key deciding factor for the president-elect in his pick.
I'm not sure how strongly the incoming Treasury Secretary is in favor of tariffs. I think he understands tariffs might be a good negotiating tool, but actually raising tariffs is going to drive up inflation. It's going to drive down economic growth, and it's going to hurt productivity. So it's sort of a pretty bad mix. Now, if you're using it to just get concessions from other countries and you don't actually have to enact the tariffs, then I think the consequences are much more favorable. But we just saw President-elect Trump talking about day one, hugely increased tariffs on Canada, Mexico, and China. Now, if that happens on day one, there are going to be pretty significant negative consequences for the U.S. economy.
Bloomberg opinion columnist and former New York Fed President Bill Dudley there speaking to Bloomberg's Scarlet Fu. And if you missed any part of that conversation, TV Go is your function. You can also watch us live. You can dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages. Check it out at TV Go. Visit. The final round of UN broker talks aimed at tackling plastic pollution is underway in South Korea. And just like the COP29 climate summit that just wrapped up, nations are deeply divided about how to address the issue. Let's cross to our Bloomberg Green reporter in Busan, Aaron Clark. Aaron, so why are countries trying to do this now?
Yeah, plastic production is forecast to jump 60% by 2040 from 2020 levels to about 736 million tons a year. What we know is that only about 9% of plastic is recycled globally. So what that means is there's going to be a significant influx of plastic into the natural environment, into marine and terrestrial ecosystems. We know that when that happens, this plastic breaks down into microplastics. It gets into our food supplies, and then it gets into our bodies. A lot of the new research is looking at the impact of chemicals in plastics and how they impact human health. And what they're finding is that it can impact things like, fertility rates for adults and IQ levels for children. So I think that's sort of the context for these talks, and that's why people are really trying to, find an agreement around a treaty that limits plastic pollution.
Is there an effective plan at this point?
There's a couple plans. I mean, the most interesting one and the most ambitious one, there's a group of about 70 countries, including the UK, Norway, and Rwanda, that are pushing for a high ambition treaty. And what they want to do is they want to phase out the most dangerous chemicals that have been linked to, negative human health impacts. And they also want to put a cap on plastic production and also begin to limit consumption, especially single-use plastic, things like plastic cutlery and plastic packaging, for which there are alternatives. One thing I would add, when you're here and talking to people, there really does appear to be broad public support for limits on for limiting plastic pollution. There was an Ipsos poll done earlier this year that found, on average, across 32 countries, 90% of people surveyed backed global rules banning chemicals used in plastics that are hazardous to human health and the environment.
And yet we're seeing opposition, of course, from oil producers. So what are the likely scenarios of how this could end?
Yeah, of course, plastics are made from fossil fuels. So there is this small group of countries, mostly petrostates, who oppose strong rules. And we've seen that in these negotiations. We've seen countries like Saudi Arabia, Russia, and Iran trying to block progress. On Monday, during the first plenary, these countries did things like try to insist on discussing principles instead of getting into the actual topics, which are chemicals of concern and production cuts. I think there's a couple likely scenarios. What the high ambition countries want to do is they want a legally binding treaty that with production limits that reduce plastic production over time, with the goal of limiting the amount that gets into the natural environment. Countries, many of the petrostates and the countries that want a weaker treaty probably want something closer to the Paris Agreement. Those are voluntary commitments, and it's not legally binding. So I think those are two different types of scenarios that we could see here.
Bloomberg Green reporter Aaron Clark there in Busan. Well, turning to the trickier issue perhaps of emissions, after the COP29 summit made some headway when it comes to climate financing, but it seemed to move further away from prior pledges to phase out fossil fuels. Carbon capture is one of the technologies that could play a part in reducing pollution. Bloomberg NEF says global capacity could rise eightfold in the next decade, but progress is on pause. Let's bring Brenna Casey, who joins us now. So, Brenna, over the past few years, we've been talking a lot about carbon capture and storage. It's been dramatic on-year expansion, a lot of growing policy support, a lot of scale globally. What's happening now?
Right. So the market right now is actually coming off the back of this hype cycle, which was kick-started by the implementation of 45Q, which is a carbon capture investment tax credit in the United States back in 2022. And so now in 2024, what we're seeing is the market come to an almost standstill in terms of new project announcements, investments, and instead what we're now seeing is this uptick in high-profile project cancellations. And so many of these abandonments are stemming from unviable project economics, lack of midstream infrastructure, and also public opposition in areas where many of these projects are sited. So most of these cancellations are actually tracked in the United States, and in Canada. So confidence in the market in some regions have begun to slip, and we're seeing this reflected in the investment numbers. So last year we saw this record-breaking total of around $14 billion of capital allocated. Instead, throughout the first 3 quarters of this year, we've only seen 4.3 billion that capital directed towards the market. So only a third of where capacity was last year. So it's definitely safe to say that we're sitting in this trough of disillusionment right now.
And those are the major markets across the board. What about specifically in Asia? What are we seeing in terms of that slowdown that you're talking about?
Yeah, so it's a similar story. Announced capacity in Asia right now is totaling around 66 million tons of capacity due to come online by 2030. But that in itself only accounts for 16% of the total announced global pipeline. Now, if we look to BNEF's net zero scenario, which models how much CCS capacity needs to be online by 2050 in order to stay in trajectory with a net zero scenario, China alone accounts for 30% of the required capacity, and then Asia in its entirety accounts for 60% of that capacity, which equates to 5 billion tons of CCS technology, which needs to be online by 2050. So we're nowhere near that. And that's really because markets in Asia, and I like to use China as an example, do not have policies or incentives in place geared towards directly kind of kickstarting or catalyzing the industry. Even so, what we're seeing in China right now, they are still the market leader in Asia with around 18 million tons due to come online, followed closely by Australia with 16 million tons by 2030. But again, more needs to be done realistically on the policy side if we are to see this dramatic uptick in capacity. It's really things like investment tax credits, carbon pricing, carbon contracts for difference that are really moving the needle in terms of, catalysis of capacity in markets like North America and Europe.
Bloomberg NEF Sustainable Materials analyst Brenna Casey, they're joining us in New York. More ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade. The latest stories on the corporate front that we're following. The Biden administration has finalised a deal to give Intel nearly $7.9 billion in federal grants. This is the largest direct subsidy from a program to boost domestic chip manufacturing. The grant is about $635 million smaller than an earlier proposal. Sources say Intel will get money for projects in Arizona, Oregon and New Mexico. Japan's biggest chip distributor is seeking possible acquisition targets in other parts of Asia. Magnica President Kazumasa Hara told Bloomberg that China, Southeast Asia, India and South Korea are all areas of interest. The company sells chips to the likes of Intel's Altera. It's also looking to diversify its business beyond semiconductors.
Yeah, we'll be watching those chip makers at the open across Japan as well, because we saw just the war staying over a week this week. Given, of course, the pressure on those tariff threats on exporters and other manufacturers, the Japanese yen even rising on that risk-off move. We're seeing the ASX 200 index at the moment trading with consumer discretionary and financials higher. It might end up being a broad risk-on day, given that we have seen also Wall Street finish at a record high. S&P futures right now not doing much, but the S&P 500 reached another 52nd record high this year. We had the Israel-Hezbollah ceasefire also helping the mood across the board. The dollar index surged after the tariff news, right now holding steady as we continue to watch the other side of that trade, as well as the Japanese yen holds steady at that 153, 154 level. This hour, we do have Australian CPI coming up, so do watch out for that. We also have later in the day the RBNZ expected to cut rates by 50 basis points to 4.25%. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens after another record high on Wall Street. Haidi, we could see more of that risk-on mood given the Israel-Hezbollah ceasefire, looking past also really Donald Trump's tariff threats.
And those tariff threats, though, do continue, right? We've been talking broadly about really getting a start before he's even in the White House. We also had, of course, the expected appointment of Jamison Greer as U.S. Trade Representative, of course, working as a protege under Robert Lighthizer, and very much in the same vein of the hawkishness we've come to expect from the Trump administration.
So it was really interesting to see the overnight session when you had even the Japanese yen strengthening on that risk-off move. We continue to see those haven flows. Right now we're holding at that 153 level against the U.S. dollar. We are seeing the Nikkei now, let's wait for it to come online, down 0.3%. And this, of course, after we already had the worst day in over a week on concerns about those tariffs. We had manufacturers, exporters really taking a big hit. We're seeing the 10-year yield holding at that 1% level. We're very close to this year's high, so we will continue to watch that. But take a look at how the Kospi and the Kosdaq are coming online as well. We had seen that pressure on that market in the overnight, in the previous session as well, not really doing much at this point. But we continue to watch the Korean won against the U.S. dollar because we're seeing some more upside. We had seen it gain in the previous session, despite the fact that we had seen that broad risk-off sentiment, because we had seen the Bank of Korea with the National Pension Pension Fund announced an expanded swap deal in currency markets, so that led to a little bit more support for the Korean won. But we'll continue to watch those manufacturers in this market as well, Haidi.
Yeah, let's take a look at Australia, which has been online for just about an hour, and we've rebounded off yesterday's lows. And in fact, some of the laggards yesterday, the banks, for example, are seeing some leadership. And in fact, most major sectors are actually trading in the green this midweek session. We're seeing the ASX up about 0.5% at this point. Watching potentially some of the weakness across gold as well as oil names, given some of the geopolitical developments that we're watching at the moment. The Aussie dollar also seeing a little bit of a rebound, still under 65 US cents there. Of course, that trading is a bit of a proxy to that China trade risk as well. And we did see that move down in Treasuries, just slipping as the tariff announcements really kind of took some of the shine off the Scott Bessent rally that we've seen over the past few sessions. Let's bring in Tim Edwards, who's a global head of index investment strategy at S&P Dow Jones Indices. Great to have you with us. There is a lot going on. So in sort of your world, what are the biggest risks and opportunities that are being seen right now?
Yeah, it's interesting. I think one of the major changes or shifts that we've seen in markets, yes, since the US election, but more broadly over the past 3 years or so, is a movement from a classic risk on, risk off, everyone watching just what does the Federal Reserve do, to a much more differentiated risk environment. We're seeing more dispersion between different countries. We're seeing more dispersion between different equity sectors. You mentioned financials, who've been, the standout performer this year in Australia and in many Asian markets. And I think it's that transition from a single risk driving markets to a much more differentiated winners and losers kind of market. And you can see that in, most obviously in what's been happening with the VIX, which closed yesterday down at 14. Now, clearly there is a lot of repricing going on. There's a lot of movements going on in markets, but they are, some winners, some losers, some are up, some are down. Diversification means that maybe the overall market can navigate through that. And in fact, you've seen that with the US finishing as another all-time high yesterday. And it seems like Australia pretty close to one today. So I think that's the most important trend to get a handle on. It's not so much risk on, risk off. It's about the opportunities for outperformance and embarrassment, but differentiated performances.
We are still seeing a broadening, though, of that rally.
Yeah, we absolutely are. I mean, that's been one of the major themes in the US post-election, is a broadening in the rally. And one of the most clear ways to see this is the S&P 500 has a sister index, the S&P 500 Equal Weight Index, which rather than being capitalization weighted has the same weight in all of the 500 stocks. That's been a super interesting index for our clients this year, but I think it's also interesting to watch. And you've seen equal weight since the summer started, outperforming the S&P 500 since the election, even more so. And so that is the broadening of the US rally and a change in leadership as well.
Tim, we had also seen Fed minutes overnight pointing to officials wanting more gradual rate cuts. At the same time, we just had an earlier guest talking about going from a Fed put to a Trump put. So does it matter at this point what happens to economic policy when we have this huge potentially inflationary moves and economically supportive moves coming from this new administration?
Look, it certainly complicates matters, but I think it's worth bearing in mind that this is not entirely unprecedented in the sense that this is not the first time that Donald Trump will be the US president. We do have the first edition of this to look back and kind of see how did markets react, how did the US Federal Reserve react. As I say, it complicates matters, but so far the Fed has been very data dependent, and part of what they're saying is we'll be looking forward at potential trade impact, but it's also just looking at the data. The room that they had is still there to cut rates, but the data's not been as encouraging most recently. So I think that's what you're seeing. It's a slightly harder job for them, but what they've done so far to me seems very much still in line with that data dependent. What data are they seeing as opposed to the forward guidance?
When it comes to the first term of Donald Trump, we actually saw a lot of other Asian economies other than China benefit from that redirection of supply chains. When it comes to investing in these markets across Asia, what do you have to keep in mind when it comes to different strategies if you have benefits from this diversification away from China, but at the same time a slowing Chinese economy doesn't help anyone?
So first of all, you're absolutely right. Markets like Indonesia, Singapore, Australia, there were a lot of different places within emerging markets outside of China that performed relatively well during the first Trump administration. I think one to single out, although there are other dynamics there more than just supply chains, is India. This year, India came very close to overtaking China as the largest weight in our S&P emerging market BMI index. It didn't quite overtake, but it came very close too. And I think those dynamics may well come back and be important in markets. From our perspective, as an index provider trying to offer different clients different solutions, one trend that I've noticed among sort of institutional investors is increasingly thinking not of emerging markets as a single block, but actually thinking about emerging markets ex-China, and then China, and then sort of taking control over their China exposure. That's something that we've seen happen with launches of products like ETFs, and also changes in benchmark about investors seeking to make sure that their benchmark properly reflects their strategy, which increasingly is taking a somewhat more active perspective on their China allocation.
How rapidly are you seeing those flows? Because we can see sentiment obviously change quite quickly. India, Japan have been sort of the market darlings. There's been a bit of a pullback on sentiment on Japan, though.
There has been. I think. Look, August wasn't that long ago, and it's worth taking stock. So the Japanese equity markets hit a high in 1989 that they didn't reach again until this summer. So it literally 34 years of waiting for another all-time high, and then they got one, and then very soon afterwards, some essentially policy statements from the Bank of Japan sent shockwaves through the market. In that whole 34 period, the worst single day for our Japanese equity benchmark was actually August 5th. So it was worse than the financial crisis, worse than the 2011 earthquake. That was the single worst day. And I think we may not be done. That was a warning signal sent to global markets, but in particular, the so-called yen carry trade, borrowing in yen and investing in more, investing in either higher yielding currencies or Japanese equities or indeed US growth stocks. Since then, there was an initial recovery, but the Japanese equity markets have traded in a sort of somewhat volatile range. And I think there is a degree of not undue caution when it comes to Japanese equities because there was, a warning signal was given. However, structurally, the longer-term trends for Japanese equities, they have been sort of improving their investability from a range of perspectives. And you're also, I mentioned 34 years, but over the last 10, 15 years, that the story of equities being a source of growth for the Japanese domestic market, that is a structural shift, and hopefully, of course, that'll continue. But to your point, there is a degree of caution, I think, that people are approaching.
What about the view when it comes to Australia?
So look, Australia is as you said earlier, has been something of a market darling. It's also been a market that is attractive to domestic and international investors for its income. One of the themes that we've seen, both on sort of index design and new products, but also just watching flows, is investors who are looking for income are looking to the equity markets for income. I think there's a defensive aspect to this. Valuations are quite high. Dividend-paying stocks tend to be a little bit more defensive. But from that perspective, both within Australia, looking at domestic Australian interest and internationally, I think the strength of the financial sector and other stable dividend-paying stocks in Australia has and continues to attract global interest.
Really great to have you with us, Tim Edwards, who's the Global Head of Index Investment Strategy at S&P Dow Jones Indices. More ahead on the Asia trade. This is Bloomberg.
Under the deal reached today, effective at 4 a.m. tomorrow local time, the fighting across the Lebanese-Israeli border will end. Will end. This is designed to be a permanent cessation of hostilities. What is left of Hezbollah and other terrorist organizations will not be allowed, well, I emphasize, will not be allowed to threaten the security of Israel again.
I am determined to do whatever it takes to prevent Iran from obtaining nuclear weapons. I have said many times that a good agreement is an agreement that is enforced, and we will enforce it.
For more on the latest developments in the Middle East, Bloomberg News Desk editor Jill Indices joins us now. And Jill, I mean, we heard from President Biden that he's designing this as a permanent solution, but we know that this is only a 60-day ceasefire. So what complicates a longer-term deal?
That's right, Shery. So ultimately, what you're looking at here is, this particular deal, the 60-day ceasefire, came about as one of Biden's main Middle East envoys was in the region, kind of shuttling back and forth between Israel and Lebanon, trying to reach some kind of a ceasefire deal. What Biden is saying there is he's kind of hoping that this is a bit of a prelude to some kind of a broader peace deal in the region. Obviously, this doesn't impact what's happening in the Gaza Strip right now between Israel and Hamas. Actually, Netanyahu and Israel have really said that they intend to, to kind of intensify efforts there, focus on efforts there. But what Biden is trying to do here, I mean, we really only have at this point a couple of months before President Trump comes to office. Obviously, President Trump has said that, he would really be a major backer of Israel in the region. Biden is trying to, orchestrate some kind of a broader peace deal before then. We'll see whether or not the 60-day ceasefire between Hezbollah and Israel ultimately creates something a bit bigger before Biden's term in office really runs out here.
The other thing is whether this should lead to any optimism about other truces or ceasefires around the region, right? Clearly, when it comes to the to and fro on the situation in Gaza, there's not a great deal of optimism at the moment.
No, there's really not at this point. But again, I think, this does represent something of a breakthrough for the Biden administration. I mean, this administration has been trying to work with Israel over the past year to achieve some kind of de-escalation, limiting of conflict in this region, achieve some kind of a peace. So again, I think what the Biden administration is hoping here is that this is a prelude to something bigger. I will say, though, that, while obviously Israel has agreed to this ceasefire, there was some opposition from some hardliners within Israel, and Netanyahu himself has said, that ultimately, if Hezbollah were to violate the terms of this ceasefire agreement, Israel is obviously there, it's prepared to defend itself. So it's sort of, a situation that presents at least some cautious optimism from some of these sides. But again, there's a lot of challenges that remain here. The Biden administration is kind of a lame duck at this point, on its way out. We'd have to see what an incoming Trump administration would really do. You've got new actors that would come into the region, trying to, sort of orchestrate some situations there. So we'll have to see what ultimately develops here.
Take a look at what we're watching at the moment. That was our Bloomberg News Desk editor, Jill Indices, with the latest. But we are seeing, of course, some of that reaction across commodities markets, which has seen quite significant moves given just the levels of geopolitical headlines we've had, be it the tariff announcements from the previous session, but also some of the ongoing concerns about trade tensions as well. We are seeing oil hold pretty steady at the moment, just really kind of trading sideways. It's likely that the OPEC Plus delay has really been countered by the ceasefire deal and the calming of those tensions around the region. We're also seeing a little bit of upside trading when it comes to iron ore at the moment, but some downside there on copper. Clearly, some of these concerns over the Chinese economy and the impact of trade pressures. Steel output in the country, though, managing to lift iron ore even as we kind of get into the start of the weakness in the season at the moment. But getting back to implications for crude markets, and Bloomberg has learned that key OPEC Plus nations have started talks to delay the oil production restart plan for January. They could even postpone further increases planned for later months. Let's get more on this scoop with our Bloomberg senior energy reporter, Stephen Sapchinsky. So, Stephen, what do we know?
Right now it looks like the situation for OPEC Plus is difficult.
right? They're facing a market that is increasingly bearish. This, as we just highlighted in the segment before, the geopolitical risk between Israel and organizations that are aligned with Iran is starting to escalate, and so that could further push prices down. And if that risk premium drops, if OPEC Plus were to add more barrels to the market starting from January, which is their current plan, and get up to 2.2 million barrels per day eventually, that would be quite a bearish factor in the market. And so there is this expectation widely that not only to balance things, they sort of need to push this back. There are a few reasons for that. Right? One, of course, that geopolitical risks I mentioned. Two, also Trump. They're not exactly sure how the Trump administration will act in the first few months or the first 100 days. If they were to put harder sanctions on Iran, then that would further curb OPEC Plus's ability to produce, and they would have to align accordingly. Maybe others would have to produce more, produce less. So overall, they're clearly in a wait-and-see situation. And with the market so kind of frothy, the supply is pretty well out there, and you're also seeing an oversupply potentially for 2025. It doesn't come as an enormous surprise to many traders in the market that OPEC Plus would consider pushing back their increase in production in January. And it could go a few months. There are some traders, analysts who think that they could push it off to the second quarter or even later.
Iran doesn't seem too happy with OPEC Plus at the moment. They've been leveling some criticism. What exactly are they saying?
They're coming out and saying that the OPEC Plus really doesn't have the ability to increase production at the moment because a lot of their market share has been ceded to the United States. They actually had quite a candid op-ed, an official had a candid sort of article that was later retracted, I might add. But essentially it laid out that, we're in a situation where if we add more supply into the market, one, it's difficult to add it, but two, also, the U.S. shale output has been so strong, despite the drop in prices, that you're adding market into you're adding into a market that's an oversupply, and that will be further, a bearish element for these countries that depend on oil prices being a bit higher.
Bloomberg senior energy reporter Steven Stepchinsky there as we continue to follow the energy markets. We're also watching futures trading across Europe right now in the Asian session. Of course, we have some downside pressure from that risk-off tone given the threats of tariffs across the world coming from President-elect Donald Trump. We continue to watch the euro because it's dropped sharply on the tariff news, but then actually recouped most of the losses given that Europe actually escaped that latest round of tariff threats. Still, the likes of JP Morgan saying that the euro will actually break parity in 2025 against the U.S. dollar. We're also watching French bond risk surging to levels last seen during the euro area debt crisis, so do watch out for that political standoff in France given some budget concerns. We have more ahead on the Asia trade. This is Bloomberg.
Treasuries and Trump's latest tariff threats have dulled some of the market optimism over the president-elect's Treasury pick. Scott Bessent, former New York Fed president and Bloomberg opinion columnist Bill Dudley, has a simple message for Bessent. Good luck. He spoke to us about the main challenges that he'd face if confirmed.
I think he can explain very clearly the consequences of not having a good set of policies in terms of what that means for the budget deficit path, the consequences for interest rates, and if interest rates go up, the consequences of interest rates for broader markets, including the stock market. So I think he can, essentially be the voice of reason to make sure that the policy mix is actually, intelligent, and that the fiscal path the U.S. has put on a more sustainable one. Mm-hmm. Right now, we have budget deficits 6% of GDP or more, as far as the eye can see. And President Trump, President-elect Trump has said that he wants to cut taxes. He wants to extend the 2017 taxes cuts and cut corporate taxes even more. And, how are we going to pay for that? So I think there needs to be someone in Treasury who's viewed as credible, but not just credible with markets, but also credible with President-elect Trump.
I am curious. I mean, two components of the job of Treasury Secretary. On one hand, they do effectively act as an advisor to the president, but they're also basically a salesman to a certain extent. They have to go out to the public, to investors, and sort of convince them that these policies coming out of the White House are productive and, more importantly, going to benefit them. Do you think what you know about Scott Bessent, do you think that salesman aspect of it, that he has the chops for it?
Well, we'll see. I think what he does have is credibility with market participants. And you saw it over the last 24 hours. The market reaction to his being named has been very favorable. Stock prices up, bond yields down. So people are happy that they have someone at the U.S. Treasury that's knowledgeable about financial markets. Now he's just got to take that knowledge of financial markets and make sure it actually affects policy, and that we have prudent policies in terms of tax policy and prudent policies on where the deficit's going over the longer term.
So that's where I want to go, because you say the markets were cheered by the nomination of Scott Bessent. But what exactly about Bessent has the bond market so relieved? When the reporting shows that commitment to tariffs, which we know are, or which we believe will be inflationary, was a key deciding factor for the president-elect in his pick.
I'm not sure how strongly the incoming Treasury Secretary is in favor of tariffs. I think he understands tariffs might be a good negotiating tool, but actually raising tariffs is going to drive up inflation. It's going to drive down economic growth, and it's going to hurt productivity. So it's sort of a pretty bad mix. Now, if you're using it to just get concessions from other countries and you don't actually have to enact the tariffs, then I think the consequences are much more favorable. But, we just saw President-elect Trump talking about, day one, hugely increased tariffs on Canada, Mexico, and China. If that happens on day one, there are going to be pretty significant negative consequences for the U.S. economy.
Bloomberg opinion columnist and former New York Fed President Bill Dudley there. When it came to the Treasury space, we didn't actually see that much reaction to the tariff threats. In fact, Treasury yields rose slightly in the New York session. Right now, they're under a little bit of pressure, but it seems the markets have already priced in a lot of these tariff news. And we had also seen the Fed minutes showing that some officials prefer future rate cuts to be more gradual. So that was something that markets were also digesting, not to mention that we do have the Fed's preferred inflation gauge also coming up this week, and we're expecting to see that October personal consumption expenditures index give us more clues about the U.S. economy and where the Fed goes in December. This is Bloomberg.
All right, we are just getting Australian CPI numbers crossing the Bloomberg when it comes to October consumer prices rising 2.1%. That is not insignificantly slower than the estimate of 2.3%. We're also getting that October trimmed mean CPI rising by 3.5%. Of course, not much of this potentially really moves the dial for the RBA, which has been a little bit behind the cycle in terms of starting the easing cycle versus most of the world at this point. But when it comes to that softer inflation number, Bloomberg Economics had been expecting for perhaps a little bit more at 2.3%. It has been padded by a slightly lower base as well. The picture broadly, according to Bloomberg Economics, does look cooler, though we're seeing easing on lower energy as well as food costs. We're seeing potential for core inflation gauges like to extend declines as well then. So this is the last that we see before the RBA's final rate decision of 2024. We've had also already a trend of inflation cooling in November as well. It could be enough to put a rate cut sort of more significantly significantly on the table as a possibility in the February meeting. But of course, that is still yet to be seen. We'll be watching for any kind of communication from the RBA on their thinking in the months to come. But let's take a look at how we're trading, because Australian stocks have already been seeing some upside today. Some of the banks have been the leaders, but really it is a broad-based rally that we're seeing here in Australia. Consumer discretionary are doing quite well as well. We are seeing, though, an opposite picture when it comes to the rest of Asia. Seeing the Nikkei 225 as well as the Kospi seeing downside of about 0.4%. We're seeing the dollar slipping. The focus still very much on nervousness around trade and tariff policies from the incoming Trump administration, I should say, sort of taking the shine off a little bit, Shery, when it comes to an alleviation of tensions between Israel and Hezbollah with this ceasefire.
And take a look at some of the big moves in chip makers across South Korea right now. We're seeing the SK Hynix stock falling by the most in more than a week. We also had news from Samsung that they're replacing some heads of their chip business. Jin Man-han will lead the foundry business, and Chun Young-hyun will actually take direct charge of the memory business. So do watch out for that annual president-level reshuffle. We continue to see the pressure on Samsung down more than 2.5%. And this is despite news that South Korea is planning to put an additional $10 billion into strengthening its chip makers to protect them against Trump's trade policies and Chinese competition. The finance ministry says it's planning to top up the fiscal support next year. Let's get the details with Bloomberg News Korea economy editor Sam Kim. Sam, so what do we know?
Well, the news that we're hearing right now from the government is that they're going to plan to, basically allow about 14 trillion won in fiscal support for chip makers, which would amount to about $10 billion. Now, this would be in the form of guarantees, insurances, and, mostly loans for semiconductor companies that are, pursuing their technological development next year. So it's not a direct handout, but it certainly helps amp up the support that, some of the Korean chip makers have been getting this year. And, with the exports of semiconductors doing well, but, this growth of export growth of semiconductors starting to soften going into next year, there's some worries that the momentum in the chip making industry is going to slow and cool. So, and with the Trump administration coming in and, announcing some steps that could turn out to be pretty unfavorable for some of the foreign companies like the South Korean chip makers, there's some concerns about those things. And, the government is putting up some support for these companies in case, things get really bad.
Is it also a concern about competition as well, namely the progress that we're seeing from China?
Yeah, that's right. I mean, China is also among the countries that could face pretty tough environments for trade when Trump takes office in January. And China certainly has been trying to ramp up its own chip making facilities, its own capacity in terms of memory chips, which is a category in which South Korea really reigns right now across the world. It's the biggest producer of memory chips, including the kind of high bandwidth memory that goes into computers that are powered by NVIDIA chips. So, there's a lot of pursuit. There's a lot of, effort by the Chinese companies to try to catch up with South Korean companies like Samsung and SK Hynix. And, the heat is on. I mean, the Koreans are starting to feel the heat coming from China, as well as coming from the U.S., with the U.S. government, wanting to have more of the chip making operations, on their own soil. So, it's kind of a double-edged. The pressure is coming from both sides, and that's creating this calls for the government to step in with more support.
Bloomberg News' Sam Kim there. Let's take a look at some of the other chip stories that we're tracking at the moment. And the Biden administration has finalised a deal to give Intel nearly $7.9 billion in federal grants. This is the largest direct subsidy from a program to boost domestic chip manufacturing. It's about $635 million smaller than an earlier proposal. Sources say Intel will get money for projects in Arizona, Oregon and New Mexico. Japan's biggest chip distributor is seeking possible acquisition targets in other parts of Asia. Marc president Kazumasa Hara told Bloomberg that China, Southeast Asia, India and South Korea are all areas of interest. The company sells chips to the likes of Intel's Altera and is looking to diversify its business beyond semiconductors. Shery.
And Heidi, take a look at some of these movers in the after-hour session, because we saw some big declines for the likes of Dell, HP as well. Both of these companies missing when it came to their sales revenue. Dell's declining 1% and HP's rising only 2%. So we saw those big moves, actually showing that perhaps we're seeing that slow recovery when it comes to the personal computer market. Take a look at a big mover right now in the Tokyo session, because Sanrio shareholders are actually going to sell almost 26 million shares in a secondary offering, according to a filing to the Japan Finance Ministry. So you are seeing Sanrio stock right now take a hit of more than 16%, because those shareholders are selling include the president, Tomokuni Tsuji, as well as MUFG Bank. We have more ahead on the Asia trade. This is Bloomberg.
Well, Shery, as markets continue to digest what exactly President-elect Trump's trade policies are going to look like. Of course, we had really that sort of show-stopping couple of communications when it comes to intentions to put tariffs on China, on Mexico, on Canada as well, linking it with the fentanyl trade, the drug trade, and that sort of sent markets really into a tailspin. At the same time, we're also seeing some of the key personnel continue to be potentially appointed, right? We're hearing that the transition team is readying an announcement of Jamison Greer as the US trade representative, according to people familiar with the matter. And he is sort of a known individual, if you will, when it comes to being the former chief of staff within that trade space, a longtime protege of Robert Lighthizer as well. Of course, a former Trump US trade representatives, and the person that oversaw billions of tariffs on both sides, on both allies and adversaries. So it does give us kind of a better idea of the direction that this administration is heading in. Jamison Greer has already spoken of, he's defending the president-elect's ability to be able to put in tariffs from day one, and he spoke about that even back earlier in 2024.
Yeah, we're now continuing to see all of these figures that we saw in the first term of Donald Trump make a comeback, right? I mean, we're talking about Jamison Greer, as you said. He was a prominent figure within the U.S. Trade Representative Office, working very closely with Robert Lighthizer. But we're also hearing that we might get Kevin Hassett leading the National Economic Council. And of course, he's been a staple of the conservative movement in Washington, D.C. So we're now getting some more hints of where economic policy will go from here. But what's clear is, as you've said, I mean, the tariff threats are coming even before Trump takes office, an additional 10% on Chinese goods, 25% on Mexico and Canada. So central banks around the world, not only with the Federal Reserve, really across Asia as well, could be facing this new headache and trying to figure out what policymaking under Donald Trump will look like. And now that we have these fresh threats of very steep tariffs on the top U.S. trading partners, what that could mean for economic policies within Asian countries themselves. Let's get some analysis on the potential economic impact for this region with Louis Cao, Chief Asia Pacific economist at S&P Global Ratings. Louis, always great to have you with us. I mean, we don't have a clear picture of what the tariff regime could look like once President Trump becomes president again. How are central banks around the world going to be trying to analyze where to go with their monetary policies when they're saying that they're very data dependent and that data could change?
Yeah, that's a great question. Like all of us are operating now under much more uncertainty than we would have been otherwise, including central banks. They are, of course, they were all expected to reduce their interest rates as inflation is coming down. But now that we have these external headwinds and also many risks, I think they're going to be more cautious. And we've seen already some central banks here in the region, like for instance the BI in Indonesia, who may have cut their interest rates had it not been for this increased uncertainty about trade policies, and even also about what all these uncertainties in the U.S. mean for U.S. interest rates, right? So clearly it's making their life pretty difficult for these central banks.
Yeah, we do have the RBNZ rate decision today. A cut is expected. That economy is slowing down a lot. But what are the complications if you could have a big trading partner like China take a bigger hit if we have more tariffs?
Yeah, absolutely. If the U.S. raises its tariffs on China, right, that in principle improves the competitiveness position of other Asian economies in the U.S., but you do have also those negative impacts from a slower Chinese economy and also more competition from Chinese exporters in other countries. So for many economies, especially economies like New Zealand, probably on a net basis, this will be a negative for them, and so that's also something that they need to look at. What will be the impact on growth in their economies?
This potentially also changes the scope or the sort of timing and strategy behind China's fiscal measures, right? Do you expect them to try and keep more dry powder because this could be sort of, a 4-year thing that they need to deal with and not just along their own timeline of how to boost the economy?
Yeah, I think so. We've seen, right, we recently had a whole range of measures, quite useful things happening also on the fiscal side, but not a lot of new money injected into the economy. And we think, that is in part because the authorities in China have already been operating in a risk management mode for quite a while, and I think they want to indeed keep some powder dry because they know that this is not going to be over soon. So I think that they will want to have some munition left in 2025, 2026 for when things really get tough.
And I did sort of want to look at the sort of domestic challenges, right? Because that supply side, the inventory side for property seems to be a real sticking point. Do you see further room or scope for more effective measures from Beijing, given that seems to be kind of the crux of what could potentially really revive, household confidence and consumer sentiment?
In principle, yes. The problem is that it's very expensive because we have a large inventory of unsold housing and we still have unresolved financial issues among property developers. So, there is scope on both of these fronts for the government to do something, but it's very expensive for the government to just buy up large numbers of apartments, right? So they have found it difficult. The economics of this are not always very appealing for the local public entities that are involved in these schemes. So I think, realistically, we're going to have to be a bit patient. That stabilization of China's housing sector is going to take a while.
When we had the first round of tariffs under Trump 1.0, what was the overall impact on trade in the region? Because I'm thinking about economies like South Korea that are so export dependent. Do you get a rise of exports just because you have a stronger U.S. economy, if you have more stimulus measures and more fiscal measures on that side of the world as well? Or do you just get impacted overall because of tariffs?
The world is complex, right? So in principle, these economies like South Korea, they should have benefited from the hardship that Chinese exporters faced in the U.S. market. We definitely saw that China's market share under the Trump 1.0, we saw that China's market share in the U.S. came down very strongly. The economies that picked up that market share have been Mexico, some Southeast Asian economies. I think less so for Korea because there hasn't been a lot of, a lot of movement of manufacturing capacity into Korea that moved out of China, right? So I think for these economies like Korea, it's not always that easy either. The Korean green transition economies, the green transition companies like the battery makers, for instance, they've been they have suffered in the U.S. as they thought that they could bank on the U.S. market for sales. It's a tricky environment for countries, but also for companies to deal in at the moment, with increased uncertainty and with everybody trying to respond to trade tariffs and industrial policy. The world has become much more complex.
Indeed. Louis, really great to have you with us. Louis Kaus, who's a chief economist for Asia Pacific at S&P Global Ratings. You can watch us live and see our past interviews on our interactive TV function, TV Go. You can dive into any of the securities or the Bloomberg functions we talk about, plus become part of the conversation. You can send us instant messages during our shows. It's for Bloomberg subscribers only. To check it out, this is at TV Go. More ahead on the Asia trade. This is Bloomberg. China's retail investors are cashing out from its exchange-traded funds, risking further market volatility if Beijing fails to boost sentiment. For more, let's bring our China correspondent Min Lo. So what are we seeing here in terms of how quickly retail investors are retreating and how this could have a bigger impact on the broader stock market?
Yes, so in China, retail investors are a very important group to watch because they make up about 70 or 80% of market turnover compared to just 10% in the U.S. stock markets, for example. And in China, according to Haitong Securities Analysis, they are seeing huge outflows in these mainland ETFs that track the major indices like the CSI 300, the Chinex Index and the Star 50. The combined net outflow there since late October to late November amounts to about 40 billion yuan, which is on track for the biggest monthly sale on record. And for context, back in October, in 1 week alone, we saw net inflows of about 35 billion yuan to one ETF alone that tracks the Chinex Index. So it's quite a dramatic reversal of sentiment here. Remember, in October, there was a huge frenzy to open up trading accounts in mainland China, but that has really petered out. We are looking at daily turnover on the chart there. You can see it's about half of the peak in October. And as well, the MSCI China, we have lost about 18% of its value from the October peak. So now a lot will depend on what Beijing does next in terms of any clarity over how it will deal with the Trump tariffs and to lift consumer sentiment. Investors will likely want to kind of wait for more signals before putting more money into the market.
So are we going to see more sideways trading? I mean, as you said, we have seen this downtrend even before the tariff threats from Donald Trump were announced.
Yeah, I mean, if you look at the Hang Seng futures, it's quite flat at the moment. Yesterday, it was largely a risk-off day after the tariff announcement, 10% on Chinese goods. If you look at the overnight session in the U.S. as well, continued sell-off there in the U.S. ETFs, tracking the China stocks. But again, long-term investors will likely want to wait a bit to ride out this uncertainty. And as well, we're watching the currency very closely because yesterday, the PBOC set the fix at the strongest level in a week, and judging from the trend so far, the PBOC has been setting the fix at stronger than 7.2 yuan per dollar. So it looks like any move to counter those tariffs, the priority is likely to protect the yuan in the meantime to prevent any rapid capital outflow, and any move to counter that tariff is likely to come from any domestic stimulus.
Bloomberg's China correspondent Min Lo there. Now, shares of Chinese express delivery firm SF Holding are set to debut in Hong Kong today in what could be the city's final major listing this year. Asia Equity Capital Markets reporter Julia Fioretti joins us now for more. And Julia, we can see those live pictures right now. The mood seems to be pretty buoyant as we were waiting that listing and that trading. But at the same time, we have seen this overall pessimism and this shadow coming from uncertainty from the incoming President Donald Trump's tariff policies. So how significant will this Hong Kong IPO be for the broader markets today?
Well, it certainly continues a trend that we've been seeing of sort of established and institutionalized companies coming and listing in Hong Kong and actually getting a breadth of global demand that we hadn't seen in Hong Kong for years. International investors had basically shied away from Hong Kong IPOs. Now, obviously, as you said, there is the uncertainty from Donald Trump's election and what he will do on tariffs. And so in terms of next year, it's a little bit hard to say. But for now, since September and since Beijing started its stimulus blitz, we've seen quite a lot of, well, several large deals do well, price well, and get good demand. And so it certainly looks that things are picking up a little bit. Whether it's sort of a huge rebound, it's still too early to say. But IPO volumes are already more than double what they were last year, although they still remain far below what we had seen in 2021 and prior to that.
When it comes to sort of a continued momentum, right, expectations for next year, as you said, there's a great sort of geopolitical uncertainty, but how much of it also depends on how much support we see from policymakers, both, you know, onshore and in Hong Kong to support sentiment?
A lot depends on that as well. So there's the uncertainty from the geopolitics and relations with the US, and that's only going to be, we're only going to see that play out next year. In terms of continued policy support from China, that's obviously also a huge boost. So far, it's helped the market somewhat, but it still hasn't quite got it round, sort of round the hump, so to speak. So we're still waiting to see whether that will happen.
Bloomberg's Julia, if you're ready there as we await that SF Holdings IPO ceremony in Hong Kong. That's it from the Asia Trade. Our markets coverage continues. The China show is next. This is Bloomberg.